Here's the rewritten version with completely rephrased wording, different vocabulary, sentence structures, and expressions, while preserving the exact same length, structure, flow, sequence of ideas, tone in every single point section. Nothing has been cut or added, only the words have been changed to avoid any direct copying issues. Silver Surge, this update is critical for you. Silver and gold aren't merely climbing today, they're declaring their presence loudly. If you followed this sector for even a moderate while, you sense it deep down. A major transformation is occurring beneath the surface of the charts, behind the news stories, and beyond the so-called specialists who insist this uptrend is exhausted. Right now, within the past day alone, new developments have emerged from Japan, additional indications from China, a major ripple from Hong Kong, and a serious alert issued by one of the biggest precious metals dealers worldwide. When you place these events next to each other, they stop looking like isolated incidents and start forming a clear sequence. In this discussion, I'll explain what that sequence reveals, its potential implications for silver and gold over the coming period, why so many remain behind on this trend, and which signals to monitor ahead so you avoid lagging behind. Sure, we'll cover the current levels, but the real focus is on understanding the reasons driving this behavior. Before we jump in, a brief message. I'm actively working to counter duplicated and reshared material, and this effort succeeds only when genuine supporters step forward. If you appreciate this content, please subscribe and leave a simple comment with the phrase Arjonag to help the platform recognize this space deserves visibility. Also, take a look in the description below once finished. I've included extra resources for you there, such as the exclusive WhatsApp group invitation and the membership option for more in-depth analysis, plus additional perks. Let's dive right in, starting with the initial sign that's appearing in a place few bother to check. It's something visible only when contrasting the financial paper narrative with actual on-the-ground reality. At this moment, silver and gold are delivering a warning that's simple to overlook if you merely skim the graphs. During quiet periods, values can wander sideways for extended stretches, letting everyone act as though conditions are routine. Yet in times of pressure, the subtle elements begin shouting. One key element involves the connection between current spot levels and futures contracts. When today's price outperforms the later dated ones, it's far more than a minor chart quirk. It's the marketplace informing you. Demand exists immediately. In the metals arena, immediately carries serious weight. Traders frequently mention contango and backwardation as casual terms, but their importance is straightforward. They offer insight into pressure levels. They indicate comfort or discomfort with availability and physical fulfillment. This is crucial since silver isn't an area where additional quantities can appear on command. Silver operates as a sector where abundance can be assumed until actual delivery is demanded. I won't claim a precise target or timeline here like some overhyped sales pitch. What I will state clearly is a fact. These kinds of setups typically appear prior to significant advances, not afterward. They serve as early alerts, and alongside that development, the next indicator rings even more clearly. Asia is valuing physical metal in ways distinct from Western markets. This creates real tension for the traditional framework. For decades, the global system acted as though the benchmark quote on paper defined everything. Yet the tangible market ignores digital entries. It focuses on what is obtainable, the speed of acquisition, and the extra cost to secure possession. Therefore, ongoing markups in important physical centers aren't minor details. They represent a fundamental change in how true value is established. The market is declaring it no longer accepts the scripted version. That's precisely why China's role stands out, not merely for dramatic appeal, but due to its sheer magnitude. Magnitude of purchasers, production capacity, industrial consumption, and financial resources ready to mobilize with policy changes. Western thinking has long viewed precious metals as a specialized interest, a pastime for certain groups. However, once industrial needs, private buying, and large-scale investment align simultaneously, the category ceases being marginal. It turns into a core element of the system. Meanwhile, while online debates rage over whether silver appears overheated, the far more relevant inquiry is, what if silver has actually been undervalued for an extended period and is now simply correcting upward? That perspective clarifies why corrections fail to resemble breakdowns. Instead, they resemble pauses, purges, mechanisms to remove unsteady participants, while the deeper momentum continues gathering force. This is the precise point where conventional explanations begin sounding strange. As values climb, a predictable pattern emerges. Initially, dismissal. Next, mockery. Then, claims of short-lived duration. Finally, just as clarity arrives, sudden warnings appear. They'll declare the advance finished. They'll insist the peak has passed. They'll claim sophisticated participants are leaving. Yet silently, the actual commodity grows scarcer. Today, I want to step back and highlight the two primary drivers propelling everything ahead. Daily reports hold importance, certainly, but the larger economic backdrop provides the real power. The initial major driver involves global divisions increasing, You notice it across the board. Commerce has evolved beyond simple exchange. It's now strategic influence. Money itself has become more than medium. It's a tool of power. Logistics networks have shifted from efficiency to protection. In such an atmosphere, reliability emerges as the scarcest resource. And when reliability grows scarce, assets independent of counterparty faith gain appeal. That's the historical reason gold endures through political changes, and why silver, during periods of constraint, can ignite explosively. Silver functions as both monetary instrument and essential component. It's an important resource disguised as a luxury asset. The second major driver centers on monetary tension, particularly in fixed income securities. Many still miss this distinction, so I'll state it directly. Sharp increases in bond returns aren't invariably positive. Frequently, they reflect markets requiring greater compensation due to rising unease. When bond values drop, liquidation occurs, not from confidence, but from desire to exit, need for immediate funds, or mandatory portfolio rebalancing. Therefore, observing increased bond fluctuations alongside rising metals isn't accidental. It's the range of options contracting. Consider the historical approach. For a long time, investors relied on a straightforward strategy. Equities advanced, fixed income offered shelter, currency remained secure. That approach bred complacency. It fostered belief in perpetual support beneath all assets. Yet when equities falter, fixed income falters, and currencies falter, the familiar strategy collapses. When the familiar strategy collapses, individuals hunt for alternatives. That hunt is underway presently. Now consider Japan, serving as a textbook example of prolonged ultra-low interest rates creating systemic dependency. Japan's debt securities have anchored worldwide finance for generations. They fueled borrowing strategies, they supplied cheap financing, they were regarded as dependable infrastructure. However, dependability differs from resilience. Often, dependability simply postpones adjustment. When interest rates climb substantially, calculations shift, exposure changes, capital movement patterns transform. Should borrowing positions reverse, the reversal occurs chaotically, like panic at a jammed doorway. The crucial insight? When substantial funds must reevaluate debt security dangers, they don't merely rotate among similar instruments. They question, what possessions do I hold that carry no third-party obligation? Gold carries none, silver carries none. They aren't flawless, yet they demand no institutional compliance. Thus, Japan transcends a local issue. It reflects what unfolds when debt markets rediscover caution. Concurrently, another dimension emerges. Equity declines, coinciding with metals holding firm. This matters greatly, as historically during broad sell-offs, metals often declined alongside everything else as liquidity was sought. Yet when metals resist while stocks weaken, it points elsewhere. Redirection. It indicates capital isn't merely fleeing, it's selecting deliberately. That deliberate selection gains strength as reliable havens diminish. Property carries its own patterns and vulnerabilities. Digital currencies swing wildly. Equities face valuation concerns. Debt instruments show instability. Currency faces erosion risks. So where does capital turn when alternatives appear unappealing? Toward the overlooked segment long ignored. That segment is precious metals. Here, the principle of modest participation works in favor. With minimal exposure currently, modest reallocations generate outsized effects. Many overlook this. Broad participation isn't required for silver. Majority commitment isn't necessary. Sufficient minority involvement suffices to overpower an already constrained arena. Now let's examine the professional investor perspective, since this element can shift dynamics quicker than anticipated. Among high net worth accounts and generational wealth managers, precious metals exposure frequently remains modest. When exceptions appear, notice them carefully, not due to infallible judgment, far from it, but due to superior access to insights, counsel, and analytical tools unavailable to most. When such a participant moves decisively, it hints at concealed developments. Thus, hearing of a prominent Hong Kong figure directing substantial personal resources toward gold should not be brushed off as superficial. It's not trivial protection, it's a fundamental outlook. Such commitment communicates distrust in paper-based trajectories ahead. It grows more significant when contrasted against minimal holdings among most major capital groups. Low average exposure means enormous distance to standard levels. The distance to protective levels is larger still. Therefore, the true issue isn't excessive gold valuation. The true issue concerns global underexposure. When underexposure encounters anxiety, it transforms into pressing need. Pressing need. Encountering constrained supply means no room for compromise. Returning to Hong Kong, it occasionally reveals genuine value establishment before global acknowledgement. Charts offer endless analysis, yet observing actual cues for physical product surpasses them. Cues signal transition from concept to action. They indicate paper benchmarks no longer dominate exclusively. Rapid sellouts at key distributors don't forecast immediate catastrophe. They do reveal evolving buyer mindset. More individuals opt for tangible ownership over theoretical exposure. That difference proves vital. Calm settings tolerate paper proxies. Tense settings demand possession. Here I pause for your input as it guides upcoming content. Do you view this primarily as a financial allocation narrative, or is it evolving into a supply constraint narrative for industry? Comment allocation or shortage to show community perspective. While commenting, if you've experienced meaningful victories, professional, financial, or personal, share them below. It builds encouragement for those progressing. Demand discussion requires addressing the quietly intensifying situation, prominent dealers experiencing pressure. When major operators adjust purchase thresholds, alter handling standards, or publicly mention unusual activity, it's beyond promotion. It signals genuine operational challenge. Demand has grown forceful enough to compel unwelcome adjustments. Infrastructure faces overload. When leading entities broadcast difficulties, it underscores finite capacity in tangible markets. Digital platforms show stock until exhausted. Availability appears consistent until abruptly not. This explains the recurring paper versus physical debate. Paper agreements multiply freely. Tangible product does not. Rising physical interest strains the framework. The framework accommodates considerable volume, yet not simultaneous mass awakening. Connecting these elements prevents confusion amid information overload. We observe robust pricing, clear indications of immediacy, divergent Asia-Western valuation patterns, Japanese debt turbulence, stock market softness, high-profile commitment signals, distributor challenges. That's substantial. Collectively, it portrays not an exhausted peak. It portrays evolution, a fundamental shift, the transition from enthusiast domain to broader necessity for meaningful exposure. Assuming accuracy, the follow-up concerns acceleration triggers. Markets require few catalysts, merely one poorly timed. Possible accelerators include regulatory moves, debt crises, exchange rate turbulence, production disruptions, or sheer momentum drawing sidelined observers. The feel of progress matters greatly. Early stages invite skepticism. Intermediate stages bring missed opportunity regret. Final stages feature pursuit. Pursuit hasn't dominated yet. Evidence lies in general perception, still labeling metals as specialized, though fissures appear. Deeper exploration of an underappreciated aspect, chronic imbalance, persistent consumption. Exceeding annual output allows temporary concealment through reserves. Reserves then deplete. Depleted reserves heighten vulnerability to demand surges. Constrained arenas function this way. Movement occurs abruptly, not gradually. Rare indicators, spot outperformance versus forwards, rising regional markups, exceptional activity plus operational shifts often provide earliest evidence of reserve pressure. Another common mental pitfall deserves mention. The belief, higher value than prior year equals belated entry. That's emotion, not reasoning. Values exceed previous levels, yet remain preliminary in long-term cycles. Advancing markets advance unevenly. Phases dislodge participants, then direction resumes. Superior method avoids fixation on recent increments. Superior method monitors underlying forces for strengthening or fading signals. Currently, those forces appear to intensify. The 2% issue unifies everything and reveals magnitude potential. Minimal portfolio percentages in metals mean pricing reflects limited involvement, not broad professional engagement. Should limited involvement expand significantly, repricing follows. Repricing accelerates when tangible constraints exist. Market size contrasts prove instructive. Observing enormous equity valuations atop worldwide rankings reminds how much funding resides in trust-dependent, policy-vulnerable holdings. Minor diversion towards safeguards overwhelms far smaller arenas. Never discount modest redirection impact. Before proceeding, a brief inspirational aside for those motivated by actual experiences, rather than technicals alone. For inspiring accounts of silver-based prosperity and long-term wealth creation, description contains link to complementary channel emphasizing those journeys. Explore and follow there as well. Real examples inspire persistence. Now addressing what surprises many, sentiment reversal speed. Psychology behaves unpredictably. Silver advocates endured ridicule, marginalization, labels of paranoia or fanaticism for years. Acceptable. Derision costs nothing. But reversal occurs when former critics seek identical positions simultaneously. Disorder emerges then. Latecomers lack composure. They act reactively. They respond to sparks. Overcompensation fuels sharpest descents, not gradual accumulation, frantic demand. Responsibility first. No reckless recommendations here. I'm no financial guide. Decisions must suit your circumstances. Yet, market mechanics deserve comprehension. Silver lacks infinite creation like certain virtual assets. Supply faces boundaries. Demand diversifies. Reserves influence outcomes. Core question: expanding demand against static supply. Not instant catastrophe, yet equilibrium restores through adjustment. Adjustment mechanism typically involves valuation. Valuation allocates limited resources. That's fundamental reality, not sensationalism. Additional element involves emerging access routes, potentially unleashing volume. Discussions around pension vehicles, managed funds, broader eligibility for specific categories transcend regulation. They concern latent demand. Small initial commitments matter greatly in constrained conditions. Even more transformative. Asset digitization, supported by genuine holdings. Tech affinity unnecessary to grasp implications. Frictionless ownership of metal-linked units could attract non-traditional participants avoiding direct bars, ashtar coins, not certain, yet credible prospect. Tight conditions amplify prospect significance. Returning to current acceleration sensation. Multiple verifications converge. Price movement confirms. Tangible patterns confirm. Broader pressures confirm. Professional indications confirm. Stacked verifications build assurance. Addressing persistent temptation. Concentrating solely on silver while disregarding gold, or vice versa.